You wired 6.2 million baht from overseas. You signed the purchase contract. Your lawyer told you everything was fine. What your lawyer didn't check, and what killed the deal at the Land Department counter, is that the foreign quota in that building hit 49% 3 months before you signed. Your name cannot go on the title deed. The developer keeps your deposit. This is not a hypothetical. The number is 49. That is the maximum percentage of a condominium building's total floor area that foreigners can collectively own on a freehold basis in Thailand. Not 50, not 51, 49. And in Bangkok's most popular expat postcodes, Sukhumvit, Satorn, Riverside, dozens of buildings have already hit that ceiling. Today we're going to explain exactly how this works, what it means for your money, and what every foreign buyer needs to verify before signing anything. In 2024, foreigners completed exactly 14,573 condominium transfers across Thailand, according to the Real Estate Information Center. That sounds like a functioning market, but here's the detail that changes everything. The quota is not calculated by unit count. It's calculated by square meters of floor area. A single penthouse sale can consume more foreign quota than a dozen standard one-bedroom units. Buildings hit the 49% ceiling faster than transaction numbers suggest, and the developer's sales office has no legal obligation to tell you how close the building is to that limit before you hand over your deposit. Here's what that means in baht and dollars. Say you're buying a 2-bedroom unit in a Sukhumvit mid-rise for 6 million baht, roughly $165,000 at current rates. You pay a deposit of 5 to 10%. That's 300,000 to 600,000 baht out of your account before the quota check happens, if it happens at all. If the building is quota saturated, you cannot register freehold title. Some developers will offer to convert your purchase to a leasehold unit instead. Others will argue the deposit is non-refundable under the terms of the contract. You are now in a dispute, in Thai, over several 100,000 baht, in a legal system you don't fully understand. That's the stakes, and it's entirely preventable. Let's run through what the law actually allows. Thailand offers foreigners exactly one route to true freehold property ownership: the condominium unit. Everything else, 30-year leases, usufructs, superficies, Thai company structures, gives you possession without ownership. Understanding the difference is not a legal technicality. It's the difference between an asset you can sell freely and one that can disappear under specific, entirely foreseeable circumstances. The condominium freehold is clean, but it comes with that 49% ceiling. The quota is tracked at the building level, and the Lands Department enforces it at the point of title transfer, not at the point of contract signing, which is why you can sign, pay, and still not register. Now let's talk about the lease, because this is where the most expats get hurt. A developer in Chiang Mai, Phuket, or Pattaya sells you a villa on what they call a 30-year renewable lease. The paperwork offers you 30 plus 30 plus 30 years. 90 years of security. It sounds solid. It feels like ownership. What nobody explains is that under Thai law, only the first 30 years of a lease can be registered at the Lands Department and made enforceable against third parties. The second and third renewal clauses exist in a contract between you and the original landowner. They are not a registered property right. Section 540 of the Thai Civil and Commercial Code sets the maximum registrable lease term at 30 years. If the landowner dies, sells the land, or goes bankrupt, a Thai court is under no obligation to enforce your renewal option against the new owner. You thought you bought 90 years of security. You own 30, and a piece of paper that feels like 90.
There's a second trap inside the lease structure. Any lease exceeding 3 years must be registered at the Land Department to be legally enforceable against third parties. Not just signed, registered. Thousands of expat lessees have signed, notarized, lawyer-drafted lease agreements that were never registered. If the land changes hands, that lease is legally void against the new owner.
the new owner can ask you to leave. Your recourse is a civil claim against the original lessor, who may no longer be reachable, solvent, or alive. Then there's the Thai company route, where a foreigner sets up a Thai limited company with Thai shareholders holding a majority of shares, and uses that company to buy land. For years, this was widely used. In 2026, it's increasingly dangerous. The Department of Special Investigation has stepped up enforcement of nominee company structures, where Thai shareholders exist on paper but have no genuine ownership or financial stake. Using a company structured this way to circumvent foreign land ownership law exposes both the foreign director and the Thai nominees to criminal liability. This is not a grey area. It is a law that was always clear and is now being enforced. The one route that does allow foreigners to own Thai land outright is the BOI exception. You invest a minimum of 40 million baht, approximately $1.1 million, in BOI-approved assets, including Thai government bonds or Thai property funds. You hold that investment for a minimum of 5 consecutive years. In exchange, you earn the right to own 1 rai of residential land. That's 1,600 square meters. Fewer than a few hundred foreigners have ever successfully used this scheme since its inception. At 40 million baht, it functions less as a property ownership route and more as a screening mechanism. There's one more mechanism that catches buyers off guard: the Foreign Exchange Transaction Form, or FET Form. To register freehold title in your name at the Land Department, the purchase funds must arrive in Thailand as foreign currency and be converted by a Thai bank. The bank issues an FET form documenting that conversion. Without it, the Land Department will not complete the transfer, regardless of what your purchase contract says. If you transferred funds in baht from a local Thai account or deposited cash through an intermediary, you will not get the FET form you need. You've paid for a unit you cannot legally register. So here's what smart foreign buyers are actually doing in 2026. Before signing any purchase contract, they're requesting written confirmation from the Land Department, not just the developer, of the remaining foreign quota in the building. They're verifying that any lease they sign will be formally registered, not just notarized. They're confirming that purchase funds will be remitted from overseas in foreign currency through a Thai bank to generate the FET documentation. And they're not touching Thai company structures for property ownership. The laws governing foreign property ownership in Thailand haven't changed dramatically in years. What's changed is enforcement and the financial cost of getting it wrong. In a market where real interest rates are now meaningfully positive and legally precarious assets are harder to exit than they were in 2022. The one thing to take from this video: Thailand has one clean freehold route for foreigners, the condo unit, capped at 49% of floor area. Everything else is a form of possession with conditions attached. Before you sign anything, check 3 things: the remaining foreign quota in the building, that your purchase funds will generate an FET form, and that any lease you sign will be formally registered at the Land Department for the first 30-year term. Those 3 checks cost nothing. Skipping them can cost you 6 million baht and a title deed that never arrives. For more on how Thai property law interacts with foreign income remittance rules, DTV visa residency, and Thailand's evolving tax framework for long-stay expats, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com and subscribe to this channel so you don't miss the next one.